There we go. Okay, there we go. So I'm Julianne. Thank you guys. Thank you everyone so much for coming yesterday and for coming back today. It means a lot. I am honored to introduce Mike Godby. He is one of the most analytical brokers in the biz. If you are lucky enough to have him as your broker, then you've seen many of his data-driven, chock full of good ratios and analytics. His spreadsheet, very useful for those of us who love, who are numbers wonks. We love that. So thank you. It adds a lot of value to the industry. So today, Mike's going to share with us his thoughts on what he's been applying his data analytical skills to lately, or for the past few months, past year probably, which is fair value marks, especially how they relate to bank stocks and bank book values in particular. So, and then if we have time, maybe you'll share some thoughts on the current market for conversions and even MHCs. We'll see how it goes. So we're going to structure this more as a conversation. There's no formal presentation. So please just start typing in your questions right now. We have kind of an outline of topics that we'd like to get to, but it's flexible. So we'll see where it takes us. So Mike, if you want to just get started. Thank you.
Well, guys, we often talk about fair value marks as being important. If anybody who's been any on my conference calls for a better part of a year now, we've discussed fair value marks. And primarily it originally started with talking about looking at the fair value marks on securities held to maturity. Naturally, we were seeing quarterly the AOCIs impacting the securities held for sale, but people were leaving out the securities held to maturity. And the guys who had the largest percentages of securities held to maturity were they were beginning to get dinged in share price, because naturally people aren't assessing tangible book by just stated book. Now all of a sudden they're taking out the securities bucket, and this stuff can be found in the call reports. It can be found in the K's and the Q's. And all of a sudden, about a year ago, maybe just about a year and a quarter, everybody starts talking about the securities held to maturity. But when you start talking about fair value marks on loans, now all of a sudden everybody wants to stop you right there. Hey, you don't want to be talking about loans yet, Mike. Nobody cares. I said, wait a minute. If a bank is going to sell, we got to take the loan marks out. Otherwise, you're not going to see if the loan marks are considerably larger than what the bank can afford to give up in a sale. We got to know what that number is. Well, if you're going to do that, Mike, you've got to start adding back in deposits. Well, this is very true, but unfortunately, the deposits, as always, lag what happens in the loan marks. And it's not just those two marks, right? I mean, let's being a conversion guy, I've got to go all the way through 120 plus pages just to get to the fair value mark sheet. And the fair value mark sheet isn't the only thing that matters, because I've got to look at the buckets. I've got to know the 5, the under 1, the 1 to 5, the 5 to 15, and preferably if the CEO is smart enough, or the CFO wants to give us enough details, give it to me in every 5-year buckets. As far as I'm concerned, the more they give us, the better we're all served. And remarkably, it's a small percentage of banks who do that. But then you step back and you say, well, that's only part of the puzzle. Some of these banks are giving us full details of what's broken down between the fixed rate loans, adjustable rate loans in each bucket. And that is perfect to write the perfect model. Without that, we're making some guesswork. We're going back and using those percentages, because sometimes you get a fair value mark that doesn't make sense to you. And it's not just the loans, it's not just the deposits. On the liability side, we've got the loans, we've got the HTM marks, the securities held to maturity mark. And then on the liability side, well, you've got your loans and you've got your HTM on the liability side. On the asset side, on the liability side, now you've got your deposits, you've got your borrowings, you've got your federal home loan borrowings, your subordinated debt. And as much as all these things do matter if a bank sells today, the deposits probably mean the least. And part of that reason is that about 15% of all of the savings and loans out there today that's stated, and of the guys who are actually stating it, and I don't know if most people know this, we've got 127 formally converted thrifts that I'm keeping track of every week. 89 of them I can pull data on, and I can pull them because they actually state publicly what their information is, either on their website or with an AK, with a K, a Q, preferably a 10K and a Q, or the prospectus that we got a year ago, and then remarkably they stopped filing. But 15% of these guys, remarkably, when it comes to their deposits, are overstated their deposits, in my belief, because they're using their DDAs as a form of improving a number. They put a long duration on that. And there is no duration on a DDA, demand deposit, but it's only 15% of those banks. And remarkably, of those 15, those averages are 6 to a 7%. Really, we would call that a deposit premium, not a core, but a deposit premium. And that bank today probably couldn't get that price. And on the other end of the spectrum, the other 85% of the guys have got a median, an average of 0.18 to 0.16, which tells you that deposit pricing is caught up and they're being very rational in how they publish this number. And then on the other end of the spectrum, which is the other vital part that we talk about every day here, is the deposits. Because these deposits, they really matter at the end, right? I'm going to be willing to pay a bank for their core deposits, but the buyer can only afford to pay so much based upon his deposit multiples, right? What's his core deposit premium? And the biggest number that's coming out of that bucket when on a bank selling out today is the loan book. Because remarkably enough, here we just been through the biggest rise in rates. And that guy who's got a single family loan book that's over 15 years, those loans are getting marked for about 22 to 24% today. I think topped out, 2 weeks ago at 25 from what I'm hearing on average. So when I got bankers telling me that, I've got bankers, the investment bankers at the firm telling me this all comes down to the negotiation. So if you think about this, a banker comes out, says, hey, we want to, meets with the management says we want to sell. Hey, let's go put together a book. They find a couple of guys that are willing to bid. Hey, they find one guy that says, I'm really willing to take you. This is the deposit multiple I'm willing to pay you. But now let's go mark the book. Oh, you got some borrowings? We could pay up for some of those borrowings. Oh, you've got deposits. Okay, go ahead.
Mike, can I ask a quick question just to clarify? The data only, it doesn't break out loan marks by loan type,
No.
So you're getting that. All we can see is the whole loan book, like where it's
That's right.
carried relative to fair value. But you're getting these individual type of loan marks from investment bankers, or who know what the market is. Okay.
Who know what the market is.
So that's something, again, we can't really see. We can just see the total and then look at the loan mix and the adjustable, fixed, try to, infer from that. But in general, are you seeing huge disparity between types of loans? And can you give us an idea just broadly between 1 to 4 family, where the fair value is as a percent of carry, and then the commercial real estate, and that itself might be all over the place.
So I would say that, the feedback I'm getting from the bankers comes down more to the buckets. They're the loan duration issues. Naturally, I think we haven't mentioned the one thing, and I mentioned this on my conference call the other day. I'm going to jump back just one moment. We'll finish up that little thing we're talking about, how they determine a price, right? But ultimately, what they're doing is they're looking through the asset quality and they're saying, okay, well, at the end, after we've given back something for the borrowings, we've given you, something back we're paying you a fair deposit multiple. Now let's take out the loan bucket and let's really say, okay, well, this is the mark we're going to give you for what those loans are worth today. And then after that, then I'm going to kick in one other thing. Now let's put a loan mark on it. Okay, we're going into a potential loan cycle. Hey, we're going to take 2% off. 3 years ago, we would have said 1. If the bank grew aggressively, maybe it'd be 1.5, right? Today, it might be 2 or 3.
Mike, are you talking credit marks now?
Credit marks,
so,
yes.
So on top of the interest rate marks. Okay, just wanted to clarify. Okay.
And as everyone is coming to terms with, you see a merger like Eastern did. These marks, wonderful thing. A bank gets to go make an acquisition, take all these marks up front, build it into the goodwill, And then over there, then 3 to 6 year period, they accreted enormous chunky numbers back over that entire period of time, all in accretable yield. Now, all of a sudden, this company has ballooned earnings, and and at the end of that, their earnings are going to dissipate back down, and some of these guys have become those perpetual buyers. I mean, when you think about the guys that came out in 2009, 10, 11, who were making acquisitions of failed institutions, most of them had to keep the acquisitions going just to keep the earnings momentum on the accretable yield. And even Chris Marinak here, the head of research, built out these accretable yield models just to show the guys who've got the most amount of accretable yield built into their earnings, so we can get back down to, hey, what are the core earnings, right?
Right. And Mike, they're not going to likely disclose that, right? What's accretable yield? So
you better have a good relationship to start breaking things down and
right,
discussing the details, and you better know what you're reading as an analyst,
right.
because I'm going to tell you that might be one up or two up on my pay grade. That's still something I haven't really gotten as intimate with as my analysts at the firm here have. But we know they are. We know what they are. We know how they come back, and we've got to be very cognizant of that, because I think people distort what happens on the upside with rates moving higher, and then the backside as rates start coming back down. And I mean, look, if you want to be so fearful of things that just occurred, that's wonderful. But if you're not thinking about, the undervalued assets that start accumulating, I mean, if you're giving a bank today that all this cash today, naturally, it's easy to say, hey, let's go give a bank money today. But that looked a hell of a lot better than giving it back, to a bank 2 years ago, or 3 years ago, where they levered it up into loans, and they bought a bunch of long duration securities, and they ate themselves alive. So, I know we're jumping around a little bit here, but virtually everyone on this call can go out to a 10K or 10Q, pull up this fair value mark page, and the fair value mark pages, consistently look the same. You're going to get the list of your assets, your liabilities, your carrying value, your fair value, and then you're going to see these three things: level 1, level 2, and level 3. And level 1 is just something you can easily calculate. Number 2, they take something they can use to calculate it, but they got to do a little guesswork. And then number 3, where the loan buckets start falling into, the loans fall into place, you got to actually put some real homework to it. And I was talking with a CEO the other day who I thought their fair value marks on the loans were meaningfully off. And he simply said, well, Mike, I'm looking at all our 15-year duration stuff, and I'm saying, look, they've got a 7-year duration. Now, this is a common theme that we're talking about on the bond desk here, who trades in Freddie and Fannies, and talking to CEOs who've gotten realistic about it. And it's as much about thinking about what that duration mark is, but then what the discounting mechanism on that duration mark. They might be 15 years, but we're talking about a 22% discount that's being built into the market today. And when the bankers know that they can bundle up a loan bucket and go sell them in the open market today for what that number is, that's just not an artificial number. That's something that they've determined. Even if the street today has 20 years of data that support a 7.02 duration, I think was the last time I looked up the number with my bond guy. I know that sounds crazy. If you think that those loans, average loan was how many percentages of loans, the vast majority of loans were refinanced at considerably lower rates than the going 8% for a 30-year fix today. And I guess we're not basing everything upon a 30-year fix. And there's still going to be divorces. There's still going to be people leaving and retiring and moving south. And there's going to be those guys that have to move their jobs. People just downsizing or can't afford it any longer. I get all that. But I think everybody's taking a running bet that it's 10 to 14 years. And God knows, I'd love to do it. You want to put a poll out with CEOs to what that number might look like to be in the next 3 years. Because if you listen to the guys in the bond business, they're saying nobody's recycling that money today. We're not getting prepayments in those buckets. So go ahead.
So Mike, just to summarize, you're saying that a 7-year average life to 1 to 4 family loans is which it's been, I think, over long term. You're saying it's biased up or biased down right now, or you think
meaningfully down, simply because who refinances 4.5, 4.25 paper? for 8% today, right? Why would I take that step back if I'm a homeowner?
Right.
Unless
So,
I ultimately have to, right?
so it's extending. It could be bigger than
It
7,
should be extended. And is
right?
it 10 years?
Which would
Is it
lower,
12 or 14? You got it.
yeah,
So,
lower the
so
mark, right? And I just wanted to point out, and actually we've got a couple questions, but I just wanted to point out when you go to that fair value table and you take the difference, you do have to tax affect it.
You do.
So,
And what are you tax affected at? Because what's the number? You know, easily put in your 21%, but we don't know when this is going to occur or have to occur, and what's the tax rate at that point. Because really, all of this stuff doesn't mean anything today, other than to the market, to the buyers who are buying things. Somebody asked me, why in the world would you put a fair value mark on a peer valuation? Well, because that's what the institutional investors want today, because disproportionately, the guys that have the least amount of tangible capital after marking for their held to maturity buckets, and then looking at the percentages of what's remaining and comparing that to the fair value marks per share on loans, those stocks have probably been more negatively impacted than the guys who have huge excess amounts of capital and low fair value marks and no securities held to maturity. I can't help that number. And by the way, the guys who performed the best in the last year, remarkably, are the guys who don't publish this information, the guys who've gone silent. And I pulled up all the data this morning, and I'm not surprised, right? I mean, what are you going to do? You're going to go call somebody and chew them out for having, nothing stated? Well, I'm sorry, he doesn't care. He's not telling you. Anyhow, I get a little amused.
Mike, just as a quick summary, so are you suggesting that the fair market values that we see on these financial statements are quite far off from if we had to actually sell that loan and what a buyer is going to go in and say that loan is worth? Is that what you're getting at?
Yes.
Okay.
And I would even say that the vast majority of fair value marks seem to be matching up with my modeling. Now, I'm going to tell you something. I know I'm going to give you just big numbers here. I could break them down into fifths, the bottom fifth, and it might be more like the bottom 17, 18%. Their fair value marks seem to be very, very low relative to these long duration 1 to 4 books. On the other end of the spectrum, you've got guys, and I'll give you, for instance, there's a bank up in Massachusetts that's got this huge bucket of adjustable rate loans, and they're 5 and 7/1 ARMs, and their number seems very large. But once you find out that they've got these large buckets of adjustable rate loans that they're putting aside fair value marks for, that stuff comes down drastically in the next 5 years. And then their fair value marks look a lot like my number. I can only work with the numbers I have, the data that I've extracted from K's and Q's. It's not there for, it's there to be analyzed, but there are little pieces of the puzzle that ultimately matter. Did you read the last prospectus? Did they break out what those adjustable loans are? Is there something else that I'm not seeing? Because there's some guesswork going on for me to assess what somebody's fair value mark should be compared to what they're stating. But it's very obvious on that one portion of banks who have very long duration 1 to 4 books that are fixed, and they shouldn't be as low as they are. And it's primarily because they're putting a very low duration. They're simply using a model that's antiquated, and I've told some of these CEOs, go to your banker, ask them what you could sell that book for. Go to your bond guy and ask him if he pulled up some of these securities of just Freddie Mac securities that are long in duration. How much did they move in the last 12 or 18 or 24 months? And that's what they're going to find out. It's north of 20%. Anyhow, it gets back to the same thing, that these things ultimately won't matter until a bank sells, but they matter to the street today. And when I went out with my NIDA model this past week, I simply reduced it to the ridiculous that if your fair value marks on your loan book are so considerably lower than your peers, then the market has told you for the last year plus that those have come down to a rational level based upon those fair value marks, and that Needham's probably being just issued at a meaningfully discount relative to their fair value marks. And I'm not going to tell anybody that it's a double, because the peers trade at twice the tangible book, or in some, or more in some cases, based upon a discounted fair value mark tangible book. But it ultimately matters that it's showing a meaningful discount. Clients have come back to me and said, well, God, this thing's coming. Now, we had a particular institution who had 65% fair value marks per share go public. And they're saying, what, you're telling me it's going public at a premium to tangible book based upon fair value mark? God, Mike, how the hell did they recover that? Well, let's talk about fair value marks. I try to explain this to everyone. We can measure a fair value mark on the basis of how long does it take to accrete enough value back to shareholders through earnings, buybacks, or dividends? Or do we have to wait for the Fed to cut rates? And how long does it take to cut enough rates to bring back a chunk of that to make it attractive enough for the institution to sell? Or do we just have to sit blindly waiting for time to pass because maybe the Fed doesn't cut rates at all? I've got an opinion on that, but everyone does. I mean, we just have to be able to calculate who's trading at the biggest discount and who gets the most back between now and potentially then for us to get the greatest amount of upside. And this went back to something I was talking with Julianne about yesterday. I mean, when you think about a new institution who has low fair value marks per share to tangible book, who has earnings that can earn it back quickly, who you're giving a lot of capital to, that can buy back stock and accrete value back, and who can loan money now at higher rates and possibly invest money into higher yielding government securities where he's taking considerably less risk, and the rates start coming back down. Imagine how quick you accrete whatever was fair value marked off back to, or the AOCI that might have been lost, but that gets recovered. Because there are banks that are going to go public in the next 3 years that are going to sell out with positive fair value marks, compared to guys who went public 20 years ago or 10 years ago that won't even be able to recover their fair value marks if we're lucky enough to get 2 percentage point reduction in rates. Just because the numbers were just so bad. They put too much in 1 to 415s. They put too much in the government securities. But it's easy to say those things. It's easy to sit at a spreadsheet and have this dialogue and be opinionated. It's a lot harder to put your money to work and invest it, knowing that you have this number, but you don't know where the Fed's going.
Right. Okay.
And look, and that number ultimately matters to a CEO who wants to sell. I know there's been a number of discussions of a number of banks who have stated things in their Ks or Qs that say, yeah, we spent a lot of money on, trying to assess what we're worth, and we determined it's not time. And it's not time because those fair value marks, they can't get paid for yet. They're just too large relative to what they want or what somebody might be willing to give them, in exchange with stock, because they're probably not going to get a lot of cash. The cash offers aren't going to be, I don't think would be big for a bank with large fair value marks. It's just not likely going to be the case. And certainly hasn't been the case with the banks that have announced. And I think more importantly, if we look at some of the banks that have announced, their fair value marks that have been disclosed as part of the mergers were considerably higher than the disclosed numbers in their Qs and Ks.
Yeah,
which
problematic.
Very problematic. So
yeah, I mean, there's a passage of time, but still.
And look, not everyone's bad. Not everyone. And by the way, I don't think people are being deceitful either in some cases. No. Some CEOs have models that them and the CFO are using. And in normal times, in rate environments that we've experienced for 30 years, well, it made sense to them. But in this environment, I mean, the older the banker is, the more likely he's got a better fair value mark. Well, they've been through more.
But Mike, also, I think the vast majority of banks outsource the fair value marks, and they don't always calculate. They don't calculate it in house. So
much more common with publicly traded larger cap banks and
with bigger securities portfolios. Yeah,
good accounting firms who will not. They want an auditable number. Okay.
Yes, but the problem is they're getting these marks from like a FinPro or from a different company than the bankers who are doing the
Real analysis. You
so
got it.
you're getting the fair values from two different sources, and that's an issue or potential.
Problematic. But this led to the other thing that we talked about because, look, a regulator seems to be very much caught up today, not in loan fair value marks, not deposit fair value marks, not borrowings, but they are caught up on those securities held to maturity marks. And I understand that this cycle of exams is going to lead to a result that some of us know have been talking about coming for the last 6 months. And it sounds to me like if you're sub 5% with an HTM mark, you're going to have probably have a capital plan in place. And I've been getting this feedback from multiple sources suggesting this. And until we actually see it happen, it's still speculation, but I understand it's coming. And if it's that important to the regulators on an HTM, because the primary issues that have occurred with some of the failed banks were related to the liquidity of their ability to liquidate securities, this is a primary issue this is part of the reason I took it out of all my numbers at the beginning of the year. I'd have no credibility if I didn't take it out of my tangible book, which leads to, that piece of the puzzle that says, okay, well, what's somebody paying for a bank like this today if there's a big, mark? Because bankers have one perception of what they're worth in raising capital. Investment bankers have a different number, and investors, we want to mark the book for everything. Hey, we might give you a little bit back for loans and for your borrowings and for your deposits, but we're taking off for that full loan mark, and our perception of your mark might be a little different than your perception of your mark. And I've heard this over and over again. So this also leads to the other thing, because when we talk about leverage in the space, it's one thing when we know what the marks are, it's interface, we trust the mark, and we can say, okay, well, this particular company is trading at a discount to this other group of companies after all the marks, and now we have a number. But let's take the one side of the group on the mutual holding company side, who the vast majority of people don't even know how to computate the number. They get caught up in what's tangible book value today, or at the bottom of the cycle when we were having failed banks, they were looking at those marks in relation to total tangible book instead of, oh, what about the capital that could be raised from selling the majority of the outstanding shares? And people were disproportionately selling some of the names off just because their marks were greater. But it's still leverage. It's leverage up when things are working great. It's leverage down when marks are considerably larger. And it's mind-boggling when I have these discussions with some people that they don't understand that second steps are going to be dictated, I believe, by how quick some of these marks come back. Because, and I'm not talking about loan marks, I'm talking about securities held to maturity and AOCI, because some of the cases, it is such a significantly larger number that you might be leaving $5, $6, $7 of potential upside on the table because the marks are so big. Now, we could talk about typical different companies, but some of the larger MHCs have got the ability to go out and acquire some failing mutual thrifts. And unlike previous failed mutual acquisitions where they were just picking all the money up off the ground and building it into the share count, creating leverage by issuing those shares to the middle tier holding company, to the majority shares, and getting the leverage that way. Today, they would be picking up low capitalized institutions, gathering all those marks, but instead of creating more value near term that's meaningful, it almost creates a delay effect on why would I convert now when I picked up all this money? If I wait a few years, boy, we'll accrete all that back, and our second step will occur at a much higher valuation. And since that capital leads to an issuance of shares and accretable value to the insiders who are basing their valuations and all of their goodies on that additional capital coming back, it would almost be foolish to issue stock at any time in the next 2 years. So I don't want people to get overly optimistic about expecting second steps to come along, because I just don't think that a rational CEO would leave that much money on the table. And I mean, in the case of, say, one of the recent small banks up in Massachusetts, they've got 19% of their capital, tied up in an HTM mark. That's 19% capital. That's a big mark. And then the highest one is Greene County with 23.5% of an HTM mark. And that's not including what they're, in some cases, some of these large AOCIs that if they just take their time and wait for rates to come back to some degree, they could recover. 1% would be roughly 20%. 5 years, they're going to probably bring back a good portion of it back, just because the maturities of these marks. So within a 5-year span, everyone's going to feel a lot different about second steps, because maturities are going to, the maturities of these securities are going to roll off. They're going to get the majority of it back. Rates come down a bit. They're going to get a good chunk of it back that way. It's just time passage, right?
Yeah. Okay, so Mike, there's a couple questions. Let me just pose to you, but I was gonna, yeah, and then I'll ask share my thought. The first is about Eastern's acquisition of Cambridge, which was unique, yeah, because Cambridge's full marks, almost took away. I'm just going to
all their capital.
Took away all of their capital, but they have a trust business. They've got a valuable, business mix, I would say. And Eastern sold their insurance operations at a nice multiple to cover these marks, and is expecting some meaningful accretion. To your point, over what period of time? Are they doing 7 years or even shorter? I think it might even
shorter.
Even
Yep.
shorter, right? So they're expecting that big accretion income.
Because a good portion of those marks were tied up in securities. The other portion of the marks were tied up in loans. And I was going to say one thing. First off, we cover the stock. I believe we're neutral on it. But the one thing I pointed out to my analyst that I think is vital, and to go back and you look at these marks, remember the marks of the acquired institution are not, they're goodwill now, right? They'll be goodwill post-merger. The fair value marks only are affected from the time the merger goes on. So if rates continue to move up, then they start marking that book again, right? But really the only marks, fair value marks they have at this point, if rates have topped, will be Eastern's marks. And when you add those additional shares and you look at the additional earnings right out of the gate, because God knows the earnings will balloon, but today, okay, day one, when the merger is completed, if you comp them on these peer analysis that are out there, and I just took my analyst peer group and I said, God, look at the marks. They're 2.5 times the average has got 2.5 times the fair value marks per share to tangible book. More importantly, they can earn them back in half the period of time. I think there's value to that, especially because get 3 years out and all of a sudden you start getting chunky years of enormous accretable yield. Life becomes a little different. Now you got to have a much longer term perspective on that one.
Unless rates come down. Unless rates
come down.
And then it all comes back, right?
And by the way, this is the other thing. You got to have enough of the insight and foresight to think about this. You take roughly $5 of AOCI per share that can be recouped, okay? Now, I'm not kidding. I know that's not a perfect number. And then you've got, roughly $2.10 a share of loan fair value marks, okay? You don't have to get much of a move on an AOCI recovery to offset that's already built into the book, to offset your loan fair value marks, because roughly 2 percentage points would recover the entire loan bucket mark. And I know, I'd have to show people on paper, but it is that simple.
Mike,
it's just a straight percentage.
You're supposed to use my favorite term, undervalued asset. Remember,
undervalued asset.
It turns into undervalued asset.
Does.
But only
these AOCIs are really, they've already been booked. We're always thinking about the mark that hasn't been booked on a merger. The recovery on a rate decline or maturities is enormous, especially for a guy who had a third of their tangible book evaporate on AOCI.
Right, right. Mike, let me just finish the question. So I wanted to give the context of the question. The question is around the Eastern's acquisition of Cambridge. So yeah, dilutive, even with the insurance sale. And so the question is, you know, is this enough to cause shareholders to, you know, vote against the merger? I know that the odds of that happening is that, but just in case, you know, we've never seen that happen, but just you know, theoretically, you know, what do you think about the vote? And then what do you think? I think the question is, what do you think would happen to Eastern stock if it did get voted down? And they still, and then you have to, then they still sold the insurance.
All right. I would think that this comes down to how short term are you? If you're holding the stock for the next year, and you vote the deal down, you just want the value back now, when you want it back now. If you're a longer term oriented guy and you look at the management team here and the management team they're gaining, you know, their perspective is they've got long term aspirations of becoming the biggest bank in the market. If you know, if that really matters to somebody who's short term oriented, it's not. I'm certainly not voting the deal down, and I wouldn't recommend that to my book. And I think my book is, you know, close to being one of the largest institutional sizes out there owning the stock. And yes, I've been wrong, meaningfully wrong, because you know, yes, did I sell the majority of my shares up at 18 to 23? Sure, I did. Did I sell my personal shares? 3/4 of it in those ranges. I still hold a quarter. I'm as much of a schmuck as I was for my whole book. And that's about the proportion of what was sold and what was held. So it's all relative. I'm a long-term investor and I see real value in it. And I talk to institutional investors who, you know, not everyone feels the same way, but if I said what the majority of my people feel, I think they look at it from here as a much better proposition for a longer-term play. But it comes back to that accretable yield, the insights to say, okay, well, if we've topped rates, how much should they get back? How much should they accrete back of that, you know, of that $5 and $2? And then in 3 years, what's exploding on the earnings side to the bank?
Well, all right. It's an interesting question. Let's see. We have another question about a thrift conversion. I just won't use the name, but a thrift conversion. So heavy on 1 to 4 family. And they've got a fair value estimate on their entire book of loans at 95% of the carrying value. So very high fair value percent. And so do you know, that could strike you as kind of bad assumptions, you know, bad input, you get bad output. 95% is high. I think let's just talk general numbers, because the third quarter numbers are still coming out. So
Yes.
We're largely using second quarter for the most part. And I think in the low 90% of is what you see overall in general, like around carrying around like 92, 93%. Again, it depends on the loan mix, but I think that's what I'm seeing. It depends maybe if you're looking at bigger banks, smaller banks, and thrifts, if you're looking at thrifts versus more commercial banks. But, you know, it goes back to my question of, do you see a real, you know, you mentioned 22 or a 20% type haircut, maybe less, like 15%ish, 15 to 20, or maybe even higher, 25% haircut in reality. But is there a big difference, you know, between the fair value estimates for commercial real estate and the 1 to 4? And, you know, are we now, given the focus on this by investors anyway, you think we start to see these inputs, these assumptions change, like from the auditors or from the external third party providers?
That's probably a good point. I have talked to some CEOs that I didn't trust the number. And I think enough people have that a couple of banks have reassessed their valuation. And not just because interest rates moved up, their fair value marks moved up meaningfully. Maybe they did exactly what I suggested, gone back out to a banker of theirs and said, hey, what are these 1 to 4s really? Look, the drastic differential that shows up in my spreadsheet are the guys with large fixed rate, single family, long duration portfolios. They're the ones who are mismatching the valuation model drastically. And I'll give you a simple rundown, right? I mean, the simplest of model is simply taking loans, multiply it by the fixed rate loan percentages, and then break it out into percentages in which the buckets are set up. So if I've got a bank that's got 80% 15 and older, well, that bucket is going to be 80 times fixed rate loan percentage times total loans. And that mark would be at this quarter's end, I had a 22.5% haircut. That's what I was guided to from multiple parties at the firm. I didn't go to just one. And guys who are actually appraising mergers today. And it matches up with one of my bond guys who are telling me how they, have different tranches of single family loan portfolios that have performed in the last 2 years. So over the last two, now granted, some of those loans might have been put on in the last, year, which means that percentage would be lower naturally. I mean, this is the case when you look at somebody like Needham, who grew rapidly over the last 12 to 18 months. So it's not a precise way, but we know the guys that I can look back over the last 2 years and see no growth and still see these buckets as large as they are, and you have to question it. You can't do anything but. And if they want to stick to their claim, and CEO has got his prerogative, if he's going to be around for the next 5 years, it might not be meaningfully wrong to stick with his guns and say, hey, I'm going to hold this number to this. But I think if he went back to people that are insightful enough to know reality, there's a way to go out and calculate it today. I mean, there's a way to precise that level 3 mark on his balance sheet. But, it's easy to be critical when you're sitting in our seat. I just know that I shouldn't own a name like that if the mark is meaningfully off. Because I think my math will prove out to be right more times than not.
Yeah, and it's a fair point. I would just add to that, though, you do have to look at their acquisitions. If they acquired those
Absolutely
loans for mark to market. So, to the caller's question, if that 95% of par, value just doesn't smell. Look to see if any of it was acquired. That could influence. Even if it is 1 to 4 family, they might have a high percentage of adjustable.
Absolutely.
Right. So that could, influence, but it's a good question. And ultimately it's hard to get to an answer, because if they're getting the data from an external, verified source,
But you can determine it rather quickly when the conversation starts going down both sides of the balance sheet. When you start talking about deposits first, and they give you the lame excuse that their demand deposits are out in long duration. And then you talk about the other side, and you're talking about loans, and they're saying they're putting short duration and they're only marking it this. And you ask the question, do you realize that these buckets, and what's the percentage of your bucket that's 15 and over and 1 to 4? Yep. Guess what? That's being marked by that. No, I didn't know that. I guess I should talk to my CFO about that.
Right.
So I think ultimately numbers will, and it's sort of like the deposit issue. The deposit issue is kind of fixing itself because more of the demand deposits are asking for much higher, and moving to CDs. And as that stuff pushes through the system, we might be topping out in rates this quarter. But the guys who will top last are the guys that have the least amount of movement in those deposits over the last 2 years. They probably have the slowest moving money on the deposit side. That's okay. We don't mind slow and you call it, patient deposits. We're happy to have that stuff because ultimately we'll get paid for that down at the back end. Yeah, that stuff will return back to that on the other side.
Yeah, I'd like to make that point about the deposits and the fair value. Maybe you can talk to it. It's counterintuitive because the higher cost deposits are worth less in the market, have a lower fair market value, but a lower fair market value is additive to your equity.
That's right.
And what's not in the fair market value pretty much at all is the value of your interest-free deposits. So you really, I mean, you
That's
yourself,
right.
yeah,
Well,
you
but
adjust.
yeah, you're absolutely correct. And by the way, but that all comes out in the wash when a bank sells. I go back to the statistics: 6 out of 10 banks will sell in, in the last 10-year bucket within 6 years. And I think those numbers are going to escalate drastically once rates start coming down again. I think we'll go back to that 1 out of 2 and 5, and hopefully that 1 out of 3 and 4, because that's where we've been. That's what should happen. And we're getting more banks who are converting out of necessity for capital. And they're willing to convert now, which means that their clock is ticking. And there are a lot of banks whose CEOs ticking, and some guys are actually retiring, even though they missed their moments. So now they're going to hand it over to the next guy that gets to let it tick. But we'll see how that works.
Right. I know we don't have that. We have a couple more minutes. So please, if anyone has any last questions, please ask. But so Mike, you mentioned, and you described how MHCs, which have just gotten, rough go. You mentioned leverage up, leverage down. We're in a leverage down environment. But what if you think rates are stabilizing? What if we are in a stabilizing rate environment? Is this the best buying opportunity for MHCs?
Well, historically, MHCs, except out the larger names, historically, MHCs have typically taken a lot longer to recover. We've seen lags of a meaningful period of time. Of course, the smaller it is, the longer it seems to lag. I think we'll have to see, how we start getting recoveries or rate changes, because to understand the math and to know how long it takes for somebody now to unlock the value because of the kick the can, rates are forced to kick the can down the road. If you want a guy to, try to issue stock today, I think there's a handful of MHCs today that are probably overvalued to a point of fault, because the likelihood of a second step occurring today would, first, if it happened today, would happen at lower levels based upon the pure analysis. And two, if we wait, the return on that investment might underperform the rest of the group as we get recoveries. Now, when we do finally get the recovery, remember, we're starting from a negative position. It's not like when we started with these fair value marks that were positive and the banks were buying back stock and accreting yield and getting the leverage working for the upside when they're making acquisitions. We still have to recover stuff that people aren't even calculating into the number. And people say, well, why would you take the fair value mark and those HTMs out? Because ultimately that impacts what I perceive a value to be. And if I'm a primary market maker in an MHC second step, I still have a little bit of an influence where the pricing should happen, because the math is the math, the peers are the peers. We don't change that. People just want it dissected. People want to see real numbers.
And on that note, perhaps we'll wrap up now.
Thank you, guys.
Mike, I can't thank you enough. I just wanted to point out on my at a glance, the one-page summaries. I've put in the stated tangible book. I think there, for most companies, there's 4 tangible books. So you got the stated. I do think adjust for the held to maturity, because banks hold securities. They have the choice whether it's in held to maturity, available for sale. So, that adjustment, I think, just makes sense. Plus, you can get it from the call report, so it's available for everybody. Then I show if you just put in all the fair value marks, if we have it, and then I take out all the fair value marks. So if you just assume everything, is worth that, they're going to hold everything to maturity, basically. And in a falling rate environment, that AOCI mark, basically it adds in the AOCI mark, that will become a positive and the undervalued asset we were talking about. So I just wanted to point that out. But all right, Mike, thank you so much.
Thank you. Thank you very much for having me.
Thank you for all
Enjoy.
the value you add. Thank you.
You're very welcome. Take care.